Spoo walks into an iStore intending to buy an iPhone 17 Pro Max, 256 gigabytes on credit over 24 months. That then quickly captures her application and gets approved. However, on initiating the contract, she is told she can't proceed because her old contract has a balance of £5 outstanding. She's surprised that they could actually inhibit her from proceeding for such a small amount. She settles the account, but is informed she has to wait for at least 24 hours for the changes to effect. On the spot, she decides she's going to pay cash and walks out with a brand new iPhone. Didn't she enter wanting to buy on credit? What happened? Because now she's paying cash upfront. She had the cash all along. Well, different mindset and approach. Betty, a recent graduate, has been saving for 12 months for a deposit for a Polo Vivo Hatch 2026 model, which is valued at about 260K. She has also built an emergency fund up to 6 months worth of living expenses. She walks into the dealer and she's told the salary is good, but they have to do a credit check. She's surprised. She's never heard about a credit check. Unfortunately, her application gets rejected and the dealer advises her to go and open a store account and possibly also open a credit card and then come back in 6 months' time and apply, and hopefully she'll get approved. Well, she's never learned about credit history and the importance of a credit profile. Now, there's a strong debate about buying on credit versus cash. Well, if you have the cash and you prefer to use it, please do so. There are some people with cash who prefer also to use leverage. It just depends with your own personal choice. As an example, consider someone paying upfront cash 1 million for a house versus someone deciding to buy 4 houses worth 1 million each and paying a deposit, plus also financing the related purchase and costs for taking up a loan. So spreading at least 250K to then buy 4 houses. Different approach from the same starting point. So some people prefer debt-free approach, and that's fine. There's nothing wrong with that. If you generate enough cash, cash might be the de facto option for you. But unfortunately, that's not the majority. For the majority of people, you're going to need credit, or they're going to need credit in order to buy, especially assets which are considered more expensive. You do not have the full cash upfront. You can leverage the lender's funds. Credit then becomes a good option, especially for income producing assets or income reducing assets, which actually add value. So an example could be buying a house today on credit. Compare this to trying to save and then buy some years later. We know that due to inflation, generally, over time, prices will usually rise faster than, for example, interest rates. So the money you borrow today could actually be cheaper in real terms later. Of course, unless you're in a deflationary slump. But for most people, they're experiencing inflation. Sometimes the cost of renting is also higher than the monthly mortgage repayment. So owning allows you to build equity in an asset. There are potential tax benefits. So there are deductions that are generally permissible, such as the interest on rental income property. You could also keep cash reserves when you don't use cash upfront, when you go for credit. Or you could use the lender's money and then invest your money elsewhere where you get better returns. So there are different reasons why people would consider to actually use credit. Well, there is a flip side. Some critics will tell you avoid debt altogether. Why? Interest adds up. You also risk financial stress if rates spike or values drop. Imagine servicing a loan for a house when the price of the house is falling, but you got a bond at a higher price, right? So cash by no means is, if it's available, means no worries, right? Because you'd have paid upfront, so it doesn't matter whether the price rises or falls. You will pay thousands, if not millions in some cases, to the bank or lenders, and money that is not yours. So you find like over 30-year period, a mortgage would actually, the amount of money you pay to service your mortgage could actually be for a second house, just due to the interest alone that you are paying. And there is also the risk of the debt trap. What happens if you lose your job or you face an emergency? You could be forced to make high monthly payments and risk repossession. And there are some people who use debt to invest in volatile assets. What happens if you encounter a market crash, right? And the losses could actually be severe and the consequences monumental. So a lot of people tend to take debt for consumption, like high risk investment schemes, holidays, gadgets, events, clothing, accessories, which are things otherwise they would not afford. And this then means that it's not a wise move, right? Credit, on the other hand, helps you leverage. It allows you to preserve cash as well as build assets, but it only works if you manage debt wisely. When you buy on credit, you have to look at how your affordability, right? In most cases, if you're going to reputable financial institutions, they'll assess whether you can actually afford the credit. So they'll look at your income versus your existing debt obligations and living expenses. And they'll usually have like a ballpark, say like maybe your credit should not exceed 30% of your gross income. But they also pay attention closely to any existing debt that you might have. Now, in order to get credit, in most cases, you're going to need a credit profile. Or this is just like your history of or your record of servicing debt or contracts, and they use this to measure that you'll be able to to service future debt. So your credit profile is just like a report which will reflect your history of borrowing and as well as repaying money. And it's generally built on how you service the debt. If you pay on time for long periods, most likely your credit profile is going to be good. And if you default or you experience judgments, then most likely your credit profile is going to be bad. And depending on the lender, one, it might mean you fail. If you've got a bad credit profile, you might fail to get debt, which is cheaper. And as a result, you tend to debt providers, which are more expensive. Right? It takes about 6 to 12 months to build a decent profile. And you can also check your credit profile, especially if you're in good and regulated environments, like here in South Africa. You can check through TransUnion, Experian, CompuScan. So there are different institutions where you can check this. It's important to establish what is the true cost of credit, right? So the price tag is not what you pay. The agreement is. So you have to look at the total cost, which is the base cost plus interest plus the fees. And in some cases, there are hidden costs, like there'll be initiation fees, service fees, and there might be even a requirement for you to take up insurance. Some cases, the insurance might be bundled. And there are also late payment penalties, which you need to pay attention to what it implies. Now, when you are taking up a contract, it's good to ask your provider for an itemized breakdown, like if it's a device contract, or a cell phone contract which comes with airtime. Know what is the device cost? Is there insurance? Is there any admin fee? What is the airtime value? And then make an informed decision. People have to be cautious about high interest debt, like credit cards. Generally, you find that like in most jurisdictions, this instrument has got very high interest. So some will develop a habit of using it because of the benefits such as rewards points, but actually service it timelessly, or using it because it exposes the bank's money, not your money, but also having the capability to pay it in full before the interest kick in. And some even go to premium lenders, which is quite painful because they're going to pay or service their debt at a very high interest rate. So all these are critical things that we need to understand. Now, most people use credit for different things, but the first thing that we're going to look at is probably my favorite. This is where we use credit for appreciating or wealth building assets, such as home loans, business related loans, or even investments. But it's important to have done your due diligence, especially as you find that most rates are not fixed, they're variable, which means they'll change, right? Some people can use for educational loans, though I'm not like an advocate for this, but it can be a consideration that one could take. Some use credit for depreciating but necessary assets. So this could be for car or vehicle financing. Some even go for furniture and appliances such as fridges, stoves, beds, television sets. Some go for even building materials or home improvements related loans. So as a full disclaimer, I've used vehicle finance, and I'm not necessarily an advocate for buying the other things on credit. Then we know some people use credit for lifestyle and convenience purchases. One of the things that you find that, well, one of the easiest things that you find is if you want to build a credit profile, opening a clothing or getting a contract like a cell phone contract or phone contract will be quite easy to do. So you generally recommend that these and types of accounts, right? But I think the challenge becomes where you buy things that you don't necessarily afford, right? My simple definition of affording is, will I be able to service that debt in its time span, especially in this category for lifestyle and convenience, in full, if ever I needed to. So generally, when you go for clothing, go for the interest-free options. Like if it's 6 months interest-free, go for that, all right? And then pay it off before you incur interest. But there are some people, they'll buy phones or tablets or laptops or even gaming consoles via credit card or retail credit. Or so they'll buy now and pay later. Or even some people buy holiday or travel related packages on credit cards. And when they are back from the holiday, they actually realize that they just lump themselves with a big debt, and it's quite painful to settle. So make sure you don't skip payments, right? And go as much as possible for interest-free options. So even if you use your credit card, aim to pay it off before the interest is charged. Then some use for short-term cash flow. So it could be applying for personal loans for emergencies, debt consolidation, or even unexpected expenses. There is an option to use a credit card to get cash, but it's quite expensive because the interest kicks in the moment you take cash on your credit card. And some even go for things like payday loans or short-term loans, and they generally have high interest. It's quite painful to see how debt has caused people sometimes to go into a serious financial distress. And short-term cash flow related loans are one of the causes. People also can use or get debt for recurring life costs. These are often overlooked. It could be for medical expenses, related loans, could be for funeral costs, could be for school fees. It's generally good to avoid certain types of debt, especially if the interest rates are very high. You can try to prepare for some of these by rather purchasing covers that allow you to prepare for the eventualities if they were ever to occur, so that you don't always have to turn to credit. Right? Now, whenever you want to take credit, please pay attention to the true cost of credit. I'm going to give you just some few examples. Consider buying a phone, a Samsung Galaxy A26 phone, which is about 5,000. If you take it on a contract, you're going to pay an initiation fee of about 150, and then they might tell you like the installment is 420, and then you've got a monthly service fee of about 65 over 12 months. So approximately you pay like 6K. So that's almost like 20% that you're going to pay extra over the year. And this excludes insurance. Imagine if you buy a phone on credit and it gets stolen, and you're now servicing the debt for a phone you no longer have. So you're most likely going to need to get insurance. Another option is, or another example I can give you is looking at buying, let's say you buy a car, the Polo Vivo or Toyota Starlet with about 300K. And don't pay any deposit. For simplicity, it's the 13.5% interest per annum over 6 years. Your monthly installment will be about 6.1K, and the total interest you're going to pay is about 139K, taking the total cost to about 439K. But there's also initiation and monthly service fees, which we estimate about 5K. So instead of paying 300K, you're going to end up paying about 444K, which is almost 50% more that you're going to pay simply because you took it on credit over 6 months. And the last example we'll look at is like buying a property. So consider buying a 1 million property in Morningside Center at 11% per annum over 240 months, which is just 20 years. There will be once-off and bond registration costs, which we are estimating about 37K. We are excluding in our calculation about 33K for property transfer related costs. So your monthly repayments is going to be about like 10.4K, and this includes the monthly fee. So approximately you're going to pay 2.533 million. So paying 1 million today versus paying 2.53 million over 240 months. Well, the choice will be yours. And this excludes insurance. So in all the examples we've talked about, we're excluding insurance. So you need to fully understand what is the total cost, right? And if you take high interest debt, the cost becomes even significant, and even the time frame in most cases that you're allowed to pay off is even shorter, exposing you even much more. So there are some practical rules of thumb that you could adopt when it comes to credit. Like, you need to know the total cost, right? And the total cost is the installment plus the insurance that might arise, the fees plus the interest. And don't just base on what the provider says, on what they say you can afford. Open accounts which allow you to service interest-free for defined periods, and then aim to pay within that interest-free. If it's a credit card, as an example, you could pay the balance at the end of every month so that you settle it before any interest kicks in. Never withdraw cash on a credit card. So it's good to build some of these rules, right? So it's got high interest and there are fees that come with doing so. Keep your utilization within the limit so that you can pay off or the asset can be settled off if a need arises. Avoid consumption debts, but if you undertake them, make sure you can service them without incurring penalties or interest. And you also have the funds to be able to settle. Like if I were to buy a device today and it's on a 24 months contract, canceling will come with penalties. So, but if you can set aside the funds to allow the device to be serviced in the full duration, and you already have the funds, you will not necessarily worry. So always make sure it's something that you can service, especially if it's for consumptive debt or accessories or lifestyle related things. And then use debit orders or automated repayments in order to ensure you pay on time. Get credit insurance or take up products which come with insurance. I always want to make people see this analogy that, like, if you buy a phone on contract, imagine continuing to pay for that phone when you no longer have it, just simply because you didn't have insurance. So consider the worst case scenario, and I have some exit plan in place. For certain bigger assets, it may mean you need to have an emergency fund, which is quite significant, maybe about 6 months, which allows you to find ways to recover and still be able to service your mortgage, as an example, right? Because we don't tend to think about the worst case scenario, but you have to think of what would happen if you were to lose your main source of income. Avoid co-signing or being a surety for someone who's got a habit of defaulting. You're just exposing yourself. If there's a cheaper way to get the same outcome, like save first, part pay a significant deposit, or buy used, or negotiate the cash price, look at all those options and then make an informed decision. Avoid using credit to pay another debt, like robbing Peter to pay Paul. This should be a no-no. And then your total debt repayment should stay generally below 30% of your income. Now, credit makes sense when the asset appreciates or it builds earning capacity, like when you invest in property or in an income producing asset. It could be even a business too. And it can also make sense if you're building your credit record responsibly, which self has value because it means you can access better rates later. You should think of credit as a bridge, not a lifestyle. Credit isn't good or bad, it's just a tool. A hammer builds a house or breaks a window. It just depends on who's using it and for what purpose. In the survival mode, credit often feels like the only option. But when it comes to stability, credit becomes a choice. You use it because it makes sense, not because you have no alternative. And that shift is the whole point of this series. Nuggets Abode: learn, build, and thrive.